All right, everyone. This is John with HTX. Thanks for tuning in on another edition of HTX Spaces. Today's topic is from tokens to systems, how crypto became a financial stack. Give me a couple minutes. We're going to get all the speakers up and everything going. All right, we're going to get started here in a couple of minutes. I went ahead and sent some invites out. So let's see here. Scott, and if you can please accept your invite. I went ahead and sent that out. I see you in the room, but I'm not sure if X is having some problems or not. And everyone else seems like it's good to go. We'll get started here in about 1 minute, and thanks for joining. Again, make sure to comment any questions you guys have on the space. If we have time, we'll definitely get to those. And today's topic is from tokens to systems, how crypto became a financial stack. And just go a little over the market here in a second. So we got Bitcoin trending up at 96,000. Ethereum's at 3,333. And a lot of privacy movement right now. We have Zcash, Dash, and Monero. All interesting coins been really going up lately. So the privacy meta is there. But yeah, this is going to be a really great space. So we'll go ahead and get started. And we'll try to get the other speakers going as soon as possible. So everyone, of course, welcome to today's chat. Again, the session is from tokens to systems. In the early days, crypto was mostly about like launching tokens, riding hype cycles. But you have today, it's a whole nother ecosystem. It's about building a real financial stack, money rails, stable coins, privacy, security, and markets that work together to create an ecosystem. With us today are many leaders from every block and layer in the ecosystem of crypto. And we'll go ahead and give them a chance to introduce themselves. So first off, Brian, hello, how are you doing?
Hey there, John. Thanks for having me. Thanks for HTX for including Stable today.
Yeah, perfect. If we're going to go ahead and do like a little roundtable, so whenever I call your name, Brian, like for example, Brian, just give a little bit quick introduction of yourself and your project. That'd be really great. If we can keep it to like, less than 60 seconds, that'd be great. Thanks.
Sure thing. So I'm Brian Mehler. I'm the CEO of Stable. I come from a background of both traditional finance and crypto. I previously led the ESBC fund at Block One. That was $1 billion ecosystem fund. And a little bit about Stable. We're building a layer one that is focused on payments with stable coins. The idea is relatively simple. We want to make sending money straightforward and predictable. Today, even though USDT is widely used, the infrastructure supporting it is fragmented, costly, and confusing. And we solve that by using USDT as our native gas token.
Thanks so much for that great introduction. I'm going to throw the invisible microphone over to Scott. Hopefully you got connected. I don't see you, but we'll have to try this, knock, knock. Are you there?
Yeah, I'm here, guys. Coming in on the Midnight account. So, hey, everyone, I'm Scott. I'm the VP of Ecosystem over here at Midnight. Midnight's privacy enhancing layer one. They got spun out of Impact Output Group, the core developers behind Cardano, about 6 or 7 months ago now. We really focus on like how we enable rational privacy through the ability to do select disclosure on chain, through fielded and unshielded transactions using some of our fancy ZK tech that we've got. My background, I guess, prior to living the life at Midnight and running the ecosystem team over here, I was a partner at Ally Ventures for a number of years and did venture building before that. So yeah, thanks very much for having this team and excited to be on the spaces with everyone.
I see. Yeah, I'm really excited you guys here because, Cardano ecosystem, you guys have a great tagline. I love Midnight, the idea of it, and it's just really great to have you here. So thanks for taking the time out. Passing it over to, I'm going to mispronounce your name, but Kaspador, how are you doing?
Hey, thanks for having me. You said it right perfectly. So thank you for having me in this space. It's a real pleasure to be here. I'm Kaspador. I'm here primarily as a community representative of Kaspa, and I've been involved in the Kaspa ecosystem for the last 3 years and working closely with the community members and obviously closely following with the protocol's technical developments. And for those that are not, or let's say, are less familiar with Kaspa, Kaspa is a proof of work layer 1, which is built on GhostDAG protocol. And this has been initially proposed by Mr. Jonathan Sampolinski. And what Kaspa basically is doing is enabling high throughput and fast confirmation while still being true to the decentralization without obviously compromising the security. So Kaspa focus has always been on scalability at the base layer, while staying faithful to the proof of work principles. And on top of this, I'm also involved with a Kasplex, which is the very first based rollup layer 2 EVM compatible built on Kaspa. Thank you for having me.
Perfect. Yeah, I've seen some great videos online about your ecosystem, how fast it is about comparison to other blockchains. So it's really glad to hear that, and good videos. Awesome. Go ahead and turn it over to Chloe with HTX Research. How you doing over there?
Hello. Can you hear me? Thank you everyone for having me today. And really love so many good projects who are launching HTX or not to be on today's space. And then wish we have a really good space tonight. Thank you very much.
Great. Thanks again, guys, for joining. We have one less person. I'm going to try to see if he got connected. I'll shoot my arrow over to Tomer. Are you there with Kima? Are you there yet?
Hey, yes, I'm here. Thank you. Thanks for having me. It was a pleasure being here. Briefly about myself and Kima. So Kima is a universal interoperability communication protocol. That all mumbo jumbo basically means that we can connect every the disconnected financial ecosystem, centralized or decentralized, to each other using an SDK and an API. To simplify, we can make bridgeless and Oracle-less transactions between your bank and Ethereum, and between PlayStation Network to Polygon to Solana to Near to your bank, to PayPal, to Revolut, to whatever you would like to think of during this unique technology, backed by MasterCard, and 3 patents in the pipeline. Also myself, an OG, I think, in the space, just because I'm old. So I've been around for a long time in the industry since 2016, exclusively investing in blockchain projects since 2019. Before that, I was investing in equity like Brian. I'm also coming from the old equities stocks world from the Web 1 era, and matured into Web 3. My VC fund is called Prime with a 3 instead of V at the end, prime.vc. And that's about it. Writing in my spare time for Forbes and Cointelegraph about the Web3, DeFi innovations, blockchain infrastructure, and mainly also RWAs as of late. So yeah, that's about me. Looking forward to having fun.
Great introduction. And again, guys, thank you guys for taking the time out to be part of our panel. And you guys that are listening, we love you guys as well. Make sure to pound that like button on the post, and also follow all of our great speakers. Give some love back to them. I got a couple questions. We're going to dig into this pretty quick. So my first question is, when crypto started, like we said, it was mostly about individual tokens, but, it's obviously progressed into something more better and more ecosystem driven. So when did it start becoming a real financial stack instead of just about individual tokens? I'm going to turn it over to Brian first, and then Tomer with Kima.
I think it's a great question to kick things off. I would say in the early days, as you said, crypto is mostly about those individual tokens, and it was used in pretty simple transfers. The real breakout moment that I think we all try to identify was when things started doing like a real system. Most likely occurred, about 2020, 2021, when stablecoins became widely used and people started relying on crypto for everyday money movement, not just the speculation side of things. That's when the focus really shifted to things like payments and settlements and on and off ramps, but also, some more institutional things like custody and compliance and the user experience. All those plumbing tools that you needed to make crypto work at scale. But as you can see now, like most recently with like JP Morgan's JPM coin, institutions are getting more serious, and then there's regulation clarity is obviously improving. What we're seeing in the US with the Genius Act, and now the forthcoming legislation But I would say that also the market demand is really starting to show that the infrastructure is dictating that there needs to be a predictable product, but also reliability. So, I mean, I think that's a little bit of like our focus here at Stable is that we want to make sure that stablecoins are continue to grow in everyday use, but also be used as real money. And we're just here to build those rails to make the system fast and predictable and get some moving parts out there for other users and businesses to start putting into play.
I have no argument with what you said, even though I wish I had some arguments. But maybe, Tomer, do you have any arguments against what he said, or you want to throw an invisible chair at him? I mean, I'm just trying to start a fight here, but...
Well, I'm not sure that we're going to fight here today. I kind of agree with everything that was said. But I think that initially, crypto when it started was a very interesting experiment. Like the proof of concept of Bitcoin, basically let the people vote if they are allowing something to be fair that no one can control, and if we'll give it value, then it will exist among us as a means of trade that stores value. Strangely enough, it succeeded. I think that the internet generation, of course, we all grew online, and open source, and wanted to share with each other and using the power of many to create something awesome. That thing finally worked, and the experiment was very, very successful. And then I think that I'm not sure that it was about individual tokens, when crypto started. So basically, when Vitalik, presented Ethereum, which was, the real deal, smart contracts into this decentralized ecosystem, that made the whole change. It's like the stories. When God, he created monkeys, and then they gave us then we Adam ate from the apple, and we got a consciousness. Suddenly, we're no longer monkeys. Here we are. Suddenly, we can decide things, and we can understand that we exist. So Vitalik did the same with Ethereum, and it unlocked the whole world of innovation that just by adding the if this then that ability to blockchains, creators starting creating their arts all over the network, and they needed these cryptocurrencies in order for their products to operate, right? It's mainly when we launch a token, the utility is supposed to be that we're creating something as a community, and the token that we're having is basically will be the means to use that tool. At least, that was the original idea. And then, of course, greed came over to the industry, and now everybody are launching tokens for nothing with no utility. They will tell you governance and DAO for every bullshit that they make. And it's supposed to be a reason to launch a token. Mainly it's due to greed, because they want to raise money quick from the industry, become rich quick without thinking too much about the utility, unfortunately. So it became a real system when real value was presented on blockchains. Excuse me if I'm not focusing on Kima, mainly now, because it's not the thing, and I don't want to sound like a commercial. But basically, when we created all of these ecosystems where these funds, these tools can run and live on, and actually give users usage and purpose, that changed the whole internet game for everyone. The internet, as you remember, I'm an old guy, as you can see, bald, old, I turned 41 3 days ago. So, I remember the internet the first days. We had it was a read-only space. Only huge companies like Sony, Warner Brothers, they created websites. And then things became easier. Suddenly, people could have servers in their own bedrooms. And they learned HTML, and they started releasing their own versions of websites. Beginning of the Web 2 era. And then blogs, content management systems, and then social media presented themselves. You just need to have an email and a password, and suddenly you can post videos on this internet thing and become famous, like Justin Bieber on YouTube. And you can become famous overnight on Facebook and Instagram by posting videos and your opinions. The Web 2 era. And look at us now. We're in the Web 3 era, when we said this thing is too strong. We cannot allow anyone to hold it. We need to give the many the rights to hold it. No one human can hold this thing because it gives too much power to a certain group, right? A bank can decide to block your funds and suddenly they're not there Facebook can decide to block your account, and everything you did for 20 years doesn't exist anymore because it's centralized. So the concept of Web3 really needs to kick in and mature just to become the web, the internet that we use today. So it becomes a real system instead when everyone can use it, it's accessible to everyone, and when things are becoming fair and transparent. Mainly when we're passing what we used to call back in the day the grandma test. If you give it to your grandmother, the product, and she can use it, this is the time, when it's ready for the market. Everybody will be able to use it. The real economic system becomes when we will pass the grandma test. We're almost there. At the moment, unfortunately, due to memes, it's still kind of a huge casino that we're all having fun with while having some real projects emerging here and there.
Yeah, they say that. Yeah. They say that, slowly but surely, right? Like it takes time to evolve, and also you can't expect the sun before the sun comes up, So I actually agree with what you both said, like the stablecoin aspect of having something stable and having something that can be done by banks or any big institution. On the other side, you have more like decentralization, ecosystem driven, and about having something that's built for like different ecosystems. I actually agree with both of what you guys said. So no arguments or chairs thrown here. I just wanted to go ahead and toss it over. And also, when you talked about decentralization, I know, Kaspador, one of the things you really highlighted in your introduction was about how Kaspa's like ethos is about, decentralized ecosystems. So this kind of prompted my next question. What part of the crypto stack has matured over the past few years, even if users may have not noticed it? So this one's going to be for Kaspa and then Midnight, Scott.
Sure. I'll review this from a Kaspa point of view because in the last, let's say, for the last years, the public attention, of course, went to the shiny things, right? On the DeFi narratives and all these meme casinos that we were discussing earlier. But in the background, we were quietly moving from assuming that blockchains must be, strictly linear to something better. And here I'm obviously talking about Kaspa, and this is the things that matured, in our opinion, for the last few years. Because, as I was saying, Kaspa launched 4 years back, and it follows a block DAG architecture. And this is a clear example of this shift, right? And basically, a DAG allows parallel block production while obviously maintaining the proof of work security, consensus, so on and so forth. So if we are talking about financials as well, you need a very good base layer to be secure, not centralized, and following the Nakamoto consensus, right? So the result of Kaspa is obviously a high throughput, low latency confirmation, and with strong security without relying on different layers, committees, and trusted intermediaries, because the voting and the DAO and exactly what the other speakers said at the beginning are now shiny things promoted as being the ultimate goal, but in fact it's not, in my opinion. So most users did not notice the evolution because obviously this doesn't change the surface of things, right? And the experience is not felt immediately by the users. It basically changes the constraints, and changing the constraints is obviously far more important than shipping new features. And what I mean by this is once block production itself can scale, the entire categories of designs trade-offs disappear. And I'm going to finish in a second. And this also makes development on Kaspa work, for example, new developments, new things that are never seen before, like vprogs, possible. So, in my opinion, and to cut it short, the stack that matured is like what matured the most, or is seeing this breakthrough and break new technology appearing, not yet visible to everyone, but I'm sure that if we are talking about monetary system, if we are talking about transactions, security, decentralization, people will turn their head and try to figure out which is the best, let's say, stack to use, right? So this was my let's say this is my view on the question.
Yeah, I mean, one of the things that really sticks out to me when Ethereum launched is it always talked about decentralization with the nodes, and also how Vitalik was like the ethos behind it was, there's a lot of things great in the space, but this is going to be the most decentralized ecosystem with Ethereum. And one of the reasons why I had trouble scaling, because, it was so decentralized supposedly, and Vitalik did all this scaling measurements and like upgrades to help it become more scalable. But yeah, like I think that's a really good perspective in alpha that you dropped, is that, it's under the hood that people don't realize what's going on. They just see the shiny object or what's going on above the technology. It's easy to understand. So yeah, I mean, it's great to hear.
Of course, and if we are obviously following the cyberpunk movement, right? That is what it's all about. Instead of shiny things, see the real usage and real, let's say, performance and breakthrough technologies. So yeah.
Yeah. I'm going to throw the mic over to Scott with Midnight. You have any insights about what he said, or do you disagree with him?
Yeah, for sure. I think it's funny, Kaspa, you mentioned the cyberpunk. I'm probably going to say like the least cyberpunk thing ever, which is like one of the things I've seen evolve over the last couple of years in crypto is like the compliance layer and how we manage risk. Like we just wouldn't have seen like all of these stable coins come in and play and all these institutions come in and play if the compliance analytics providers hadn't matured to a level whereby they could comply with like American, European, Asian regulations for this capital to move on chain and act in the way it does. And it's just something that I think, one, the original cyberpunks probably didn't really want happening. It's not really their jam, and I kind of get that. And, on different chains, you can enable different levels of compliance, including on top of Midnight. But if you're speaking to the enterprises, they want to know where the money came from. They want to be able to see what happened. And they want to do so in a balanced way. So I think that's something which maybe the regular user doesn't necessarily see and touch, but it's certainly unlocking a lot of the more TradFi use cases. And then the other area, I think a shout out to like people who've been around for a long time, and Tommy, you said you've been doing this for a long time as well. Like wallets used to be super janky. Like wallets were terrible. And they were like people's first experience of using blockchain. Like you come in and you'd be like, what the fuck is this? Like, how am I doing a transaction? What am I signing? What do all these numbers goddamn mean? And now there's like the teams like Dynamic and Wallet Connect's doing great work. Some of the custodians like Bitgo and Copper at the enterprise level, like it's just 10, 50x better than it was a couple of years ago, which just gives people more comfort and control to play on blockchains and on crypto. And I know wallets, like, they get a beating because they're still not quite there yet and they got a long way to come. But like they have come a real long way in terms of driving that adoption and making it fun and easy to use.
And I would add on top of that, if I may, with all the elements out there, like the AI, it's even easier for everyone to integrate the existing SDKs into whatever they need to, right? So that definitely drives adoptions and but risks as well. So, but still, it has matured a lot I've been in this space since 2017. So yeah, I've seen a lot, and you are 100%. I'm in agreement with you.
Amazing. Yeah. I mean, I actually like the insight about the wallets. And, I think that when we first joined the wallets, we were just atrocious. Like I can't explain to you like the frustration when I first joined. I was like, why is this so difficult? But you know what they say, like you can't struggle and you can't appreciate how things are now until you realize how bad they were before. So, I love the progression of how everything is evolution wise, growing up, especially the wallets. And, I have to say something about what Kaspa said is like, decentralized ecosystems is a really key. Like one of the reasons I think this is what I saw online a while back, BlackRock, which is like a huge corporation, they picked, Ethereum because they said to build on one of their ecosystems because it was so decentralized. Other blockchains may not be so decentralized, if you want to say that word, but I think it's really interesting to have some of these big, large institutions like BlackRock, really think in that perspective, maybe because of security, maybe because they just love Ethereum. But yeah, I think it's an interesting perspective. And thanks for your thoughts. I'm going to turn over. I have a couple more questions. So my next question is, do you think crypto today is about building financial infrastructure, or is it still mainly about trading? Everyone's building new DEXs nowadays, new sexes are coming along. So, which one is it, financial infrastructure or trading? We're going to go to Tomer with this one, and then Brian. Yeah.
So, first I must agree with the guys before me, with what was said, the guys from Midnight. So definitely, like, wallets were so bad back in the day, and what we have today is like, looking at an iPhone 17 Pro Max, and like, we used to have like the ones that you used to put your finger and circle it around, just to get a number. So the industry is definitely in a better place today. So kudos to everyone who joined late. You did not have to suffer that much. Now to the question, if we are building at the moment a financial infrastructure, it's still about trading. I think that the real serious builders around here are creating innovations that probably are the biggest revolutionizing ideas that have been created by man since the Industrial Revolution and since the Internet Revolution itself. Definitely thinking that it's it's not thinking, it is the new financial infrastructure of the world. It's the next evolution of money, 100%. Not even, it's not arguable anymore, I think. It is there, and this is what is being built. But not only financial infrastructure, also important to say that we are basically creating systems that are enabling everything to be settled without arguing on them in a permissionless, trustless manner, right? Using a decentralization. So not only money, not only a financial infrastructure, but a complete decentralized, autonomous technological infrastructure is being built. Something much more interesting than the obvious financial infrastructure that we see today. Is it more about trading? I do not think that it's more about trading, but it's mostly used by the industry's participants as a trading realm. I'd say that probably 95% of the industry that we have today, the participants in the industry that we have today, 90 to 95 are mostly using it, as a speculative investment or a casino, trying to become rich overnight. Unfortunately, many bad actors who are launching a rug pull projects just to get rich are also using it for that purpose and enjoying the lack or very, very weak, let's say, regulation and compliance that this ecosystem still enjoys from, for the good and for the bad of it. Bad actors are here also. So I think that it's mostly being used by the retail, by the users themselves as a speculative realm to gamble on tokens and on the next 100x, the next 10x, maybe in this horrible market, then maybe gambling about the next 10x at the best. But definitely being used more as a trading platform than an actual financial infrastructure. Although if you would look at the more professional industry, which are basically the ones who are creating the volume on these chains, then it's definitely being used as a financial infrastructure and is being built and created towards this decentralized financial infrastructure enforced future, empowered future. Then definitely, if we're looking at the professional industry, let's say I'm not sure if I would call it institutional, because it can be angels, it can be investors. We're using it as a financial infrastructure. If we're looking at most of the users in terms of numbers and not volume, it's definitely the biggest casino that humanity has ever had on the internet, with global participants all around the world, that most of them are also enjoying anonymity. Then for the institutional, I vote financial infrastructure. For the retail users, definitely voting the trading.
Yeah, I mean, one thing I wanted to highlight is that I know a lot of times this has come up as like you call trading like, or the casino. But I actually think like one of the things I think we're mentioning and not forgetting to bring up is that, in stocks, they have the same thing, like the traditional TradFi market, they do have crazy stocks that are penny stocks that people, they buy, invest their money and they hope that it goes up. They hope they invest like that. So I think it's not just in crypto. I think that's a worldwide ecosystem, like not just obviously in that. So I have to push back a little bit on when people just say it's like a casino. I think it's a little bit different. But as far as
if I may answer to that, I don't want to throw a chair at you, as you say, but maybe a chair will be thrown. So sorry, man. But I truly believe that there's a huge difference between launching a token in terms of the things that you need to go to pass through, and actually launching a stock on the stock market. As one, who had in the past, again, an old dog who did IPOs, the moment that you get to an IPO, the process of companies being born is completely different. A normal company, will usually be born after creating a product. They will raise maybe 100K by a valuation of $1 million from investors and angels initially. And then they will build a product, and then they will create the MVP. They will go to an alpha, closed beta. Then the beta will be public. They will generate income and money, and they will have some traction, real traction that can be measured and audited by real financial, institutions, one of the big fours. And under countries, and institutions who decide if it's fit for an IPO or not. Maybe they will have a Series A, Series B, and then they will have an IPO, and the company already has something behind it. You can see its traction. You can learn about the product. Even if it's a penny stock, you can learn what they do. You can read about the patent. You can, if it's, some kind of a pharma company. So unlike in crypto, it can be four anonymous kids, with pictures of both the Piach Club and CryptoPunk that are creating a deck full with stories made by ChatGPT and raising money by a valuation of $300 million. They go out and raise $20 million, launch a token, and it becomes a RUD. So there's a little bit of a difference between launching tokens, and I completely agree that the stock market is also completely manipulated, of course, but it's a long conversation. But there's a difference between investing even in penny stocks than investing in meme coins that are being generated. Click.
Hold on, but Tomer, and so take us back to the mid-90s. Like, how much traction, financial audit, proof of it being a sustainable business did Netscape have when it IPO'd? I think it was 2 years it was in existence before it IPO'd. Crazy wild valuations in it, and it raised. Do you not think that tokens as they are now, with their lack of investor disclosures, etc., we're just 20 years behind in that sense, in terms of how we stack up against traditional markets and IPOs? Because some of the things you've described are, yes, they exist in the IPO market, but some of the more robust token launches also adhere to these kinds of maybe not full disclosures, but looking at providing information, providing update, doing research, taking in money, etc. So there's almost a gap rather than the hard rule that ICOs are properly crazy compared to IPOs. There's just a timeline difference in terms of where we are and how mature we are as an industry.
You're completely correct, my friend, and you hit an open nerve. Then
sorry, Megan, did you lose one?
We've all been, through it. Well, not all of us. Some of the people were not born there, but we all, those of us who remember the .com bubble. Well, this is exactly what you're talking about. Where people used to throw by valuations of billions of dollars money, in companies that had nothing, because the venture capitals, of the day, and the angels, everything that had the WW in it, they said, this thing is the future. People will look at the TVs and, they will be doing everything through this TV with a keyboard and a mouse, this computer thing that you go online on the internet. And by that, the young generation of back then, used to raise money. Of course, that all of the VCs and the big players knew how to take them to IPOs. There was a different standards when and how you can go out to the market, and everything crashed. 99% of the industry was eliminated. Names that many here do not even know about. And the money was flowing to these tiny companies, that became titans and actually created the internet that we all use today, right? Like eBay, Amazon, Microsoft, Intel, Nvidia, Cisco, and the rest of the companies that created the internet and this computer generation that we enjoy to be part of today. But it took the funds of 99% to be eliminated so these can flow to the right ones, right? It's basically a natural selection process that the market did. We, unfortunately, are still not there. Imagine if we were there, right? And all of the money, the $4 trillion almost that we had in the industry, was flowing into the real builders and not into the scammers and the dumpers and the pump and dumpers. Do you guys understand what kind of a crazy innovation we could have had like over here if the money was just flowing to the right builders, to the right project, and not, to false promises? But humans, will be driven by greed, dear friends, and they will keep doing it and they will keep trying because everybody, unfortunately, many, not everybody, but many of the players think about themselves, how they can get rich, and after them, they don't mind what will be left for someone, if any, unfortunately for us. But if these funds were growing, I'm telling you, as a VC, as an angel investor, as a writer that writes about these things, and as part of the community like you guys, we used to live like with nothing, and a tiny computer in my basement, that we could already be years ahead of us. So many projects like eliminated because the founders were great developers, amazing, scientists, computer scientists who created crazy innovations. But they were very bad marketeers. They could not attract money for their token because they were not marketing it right. And people who were great marketeers, but they didn't know anything about development, went on and took billions and dozens of billions of dollars out of this ecosystem instead of them being fed with these funds. If we had the sense to learn from the mistakes of the .com era and do something similar, in our ecosystem, I think it would have been much more beneficial to all of us. Luckily for us, exchanges like HTX and some other fellas, in this industry are doing great DDs. I know how hard it is, to get to HTX, and some of the other names here with tokens, as one who took many tokens to launches, doing great work. But even them cannot see everything, that is coming from the ones sitting behind the computer somewhere around the world who sends them information and promises with the various members. So yeah, with that, now we're experiencing, I think, the rain, the flood is here, and I believe that many will be eliminated, and hopefully the funds will be flowing to the ones who need to survive, so we can all thrive in this new Web3 era.
Wow, such a great insight, you guys. I actually, I don't know who said that about the internet bubble. That actually is like a really great thing I was about to mention, and I'm glad you did. I don't know if that was Tomer, but Tomer, I had this question as you as well. Like, I got a bit off topic, but it was really great alpha you guys dropped and good insights. Tomer, do you think it's infrastructure or trading? Yeah.
Brian, you meant. I already spoke enough about it.
Oh, I'm sorry. Brian, sorry. Yep.
No, thanks. I guess a few things to touch on. One, I think much earlier in the conversation when talking about the biggest mistakes, I would say Scott from Midnight said the quiet part out loud regarding the wallet and the technology that was in place. And I think that then dovetails pretty much with what Tomer was saying in terms of like what the early days of crypto were and giving the parallel as it explains to the .com bubble. But I would say, like, from the infrastructure side, which is where I would focus on, having built another layer one, is that it's very synonymous with the early days of the internet, not necessarily only the investment side of it, but also the technology side. When things are new, it's tricky to get that user growth and that development. So I'm not sure, I remember the early days of the internet, not sure how many people here do as well. But in the early days, there wasn't really much to do. Websites and browsers hadn't been invented yet. So that's kind of parallel to the wallet. You really just had most things like chat rooms and then like message boards. And so the user interactions and the user experience was pretty not great. And I think once there was better tooling and better environments and better buildings that were a building that was going on, then you started to see the greater adoption. And then that's what led, as we're talking about with the investment cycle, I think that leads to kind of a lot of more clutter in the ecosystem. I think the parallels will exist, whether it's with the internet, as we talked about, or as we're talking about with blockchain, but then also we see that same thing going on with AI. So I think that's a natural progression. Unfortunately, it's a tough part that we all have to accept, but that's kind of how these, large scale or like technology that changes the way that we interact with things typically go. That cycle, there's a boom and a bust and then hopefully a reemergence. But I would say, from us, like we're looking to solve that real world problem with blockchain right now, because again, part of like what we inherited where there was a 2-coin system, if you want to move money, you have to own another token. And I think that's not how any other money moves in the world. If you want to move money from your wallet and you want to send it across, whether it's a SWIFT wire as we talked about, or, an ACH in the US, you don't have to have a second currency value to pay that bill. And I think, that was a friction that was designed into the system that can be easily removed. And I'm, not talking too much about stable, but that's one of the things that we did, was that we were addressing a long-standing problem where, let's say you want to send someone $100 in USDT and you help them get on board with a new wallet and you send them that wallet and they're excited to receive that money. But when then they go to move it, they then can't do anything because they have to get whatever their layer 1 token is to start paying the gas fees. And then the experience in getting that gas fee for someone who's not crypto native is pretty daunting. And it's usually where a lot of people just draw the line and just stop using crypto because they're like, this is too complicated. It's easier and faster. I just pay the fee to send it on another platform. So I would say the infrastructure is really whether it's the wallets that we talk about or, some of the non-necessary products that were built. I think that will be what changes how crypto is used, and people feel more familiar with using a product that really puts users at the center. So whether it's removing the gas token or figuring out how to handle some real distribution cases, such as payments or payroll, or remittance, or even commerce, I think that's where crypto will stop feeling like an experiment and will start feeling more like the infrastructure that people, come to rely on every day. So that's kind of a broad approach that I kind of think of things in.
It's interesting, right, Brian, because you're talking about like the innovation around gas tokens. So at Midnight, we've gone a slightly different route. We have like a resource token that is emitted when you hold our native token. You can pay for transactions and it decays over time and it disappears, which on the one hand, we hear enterprises like, and that's golden. There's the other approach of like not having gas fees or allowing them to be paid in the token that you're transferring. And then there's almost like I don't want to put words in your mouth, but it's like an older school way, which is wild to say, even though crypto's not that old, of this idea of using the native token to pay for transfers and being exposed to the volatility. So we're seeing like an evolution of how people pay for transactions on chain. I don't want to like hijack, but does anyone think like that will change over time? Like, have we settled how that works, or are we going to move in a different direction? I don't know what you guys are seeing, Brian, Kaspa.
Yeah, I mean, sorry to jump in again, but I think we go back, as you mentioned earlier, like the grandma test or the mom test. I think this is really where it is like, if you're saying using crypto is better than sending fiat, meaning that it's 24 hours a day, 7 days a week, available to anyone in the world, but then, you're presenting this perfect product. But then if you start saying, well, there's actually all these asterisks that we haven't disclosed. One, you have to use a different currency and these networks. And if someone has a preference for one, then it doesn't work. And I think that was kind of one of the things that held back crypto adoption, was that it wasn't as easy as it was made to be seen. And so kind of the example, if you just, let's say you're going to send a lot of transfers. So you buy a bunch of a layer 1 token that's a volatile gas token, let's say for equivalent of $20 US. And you're like, okay, that's fine. I can pay 100 transfers out of this. But then the price of that layer 1 token drops to, let's say, $10. You no longer have the ability to send 100 transactions that you kind of had made the justification for. Rather, now you have 50 transactions. But then you have to take into consideration network spikes or congestion on the network. Well, it's going to cost you twice as much. So now you're down to 25 transactions. So now it became a lot more expensive when people told you, oh, it was going to be way cheaper and easier. And that's kind of one of the things I think that we will see the networks adopt to, in terms of like that volatility wasn't necessary. Understanding the volatility, and as I think Tamara was mentioning earlier about like investing tokens and tokens that are store of value, that's part of that game. If you want to invest, whether it's a penny stock or a volatile token that's launching for, from speculation purposes, I think that's the assumed risk. But I think in terms of moving money, you shouldn't have to play spectator or a speculator. You should be able to understand how much you're paying and how much it's going to cost, whether it's today or tomorrow, not, game the system at different rates every day. But I think that's kind of like my thought is like we kind of section it off, or like payments will work in a much more open sense. And if people want to speculate and invest elsewhere, that's their prerogative and they're more than welcome to do it.
I love the idea of removing the asterisks. It's like a really well phrased what we need to be doing as an industry.
Very, very cool. Yeah, it's a great thing to see things come together and make it faster, easier, and simple for everyone. I think that we all can agree on that. I'm going to turn over to Chloe. Chloe, same question. Infrastructure or trading? How has crypto evolved?
Yeah, for my side, I think nowadays meme coins really important track for onboarding new Web2 users, including retail users to trade and marketing hotspots. And right now there's a lot of meme in these years Dodge and PayPal and bulk. And then we also found that there's a lot of meme in BSC, really launch a lot and give a lot of wealth effects to HTX users. And so AirTrack, a lot of attention right now. And also at the same time, the institution guide funds and long-term capital focus on fundamental infrastructure, such as stable coins and layer one chains. So recently we already launched the ticker name on HTX and increased 80%. It shows the monthly demand of the stable coins and remains really high. And many large capital players such as Tesla investing really a lot and paying a lot of attention to this kind of stablecoin projects to increase safety and security of their funds. Yeah, I think both also important.
Yeah, I think it's a really tricky question. I meant it that way, like infrastructure or trading, but it can be both, right? So it's a really good point that you guys all made. I'm glad I got some really great insights in Alpha. Thanks, Chloe. I think my next question is going to be kind of negative. So hopefully we'll get some throwing chairs at each other again. So what are the biggest mistakes the industry has made in the last cycle? And what did we learn in the hard way, so to speak? I'm going to throw my mic over to Kaspa. Go ahead.
I thought you would say you're going to throw over to me a chair, but the biggest mistakes, in my opinion, so the saying, fast and cheap is not good. Or you might have some, let's say, corner cases where you can deliver something time to market very, very fast, but with severe caveats. Again, this is my personal perspective as a community member of Kaspa, right? So, in my opinion, since 2017, because I caught all the craze, ICO, IDO, pre-sales, the casino thing that we are still talking about, right? Memes, everything. I saw all the scenarios unfolding in front of me. And as Tomar was saying, let's build a shiny page and everything is up and ready. We are going to gather millions of dollars and we will deliver this whatever project that doesn't do actually anything. So, for the last few years, in my opinion, all this hype around stuff that are not tangible, the pressure of the community to see something delivered instantly without thinking about security, without thinking about scalability, without thinking about how to actually deliver something meaningful, drove us where we are today in terms of, again, the topic meant for the casino. So if we are following and trying to catch the shiny things, AI made page and some promises put on paper by some random guy, we are diluting that what crypto and this space means. Of course, depends on what lenses or let's say what hats you are using or wearing, right? Because if you look at this from let's say Digen person, you're happy with this. You have more room to play. You can just see what's happening there. But if you are looking at this as an actual investor, or as Tamar was saying, as a VC or angel investor, right? You are being, of course, you have the maturity of not being distracted, but the normal user is being distracted by all the pods that are flying and floating around without an actual use case. So, in my opinion, the mistakes were deliver fast without considering, as I was saying, security, scalability, and actual working product, promoting let's say projects and ideas that maybe don't have a go-to-market defined. Maybe they are just a shiny PowerPoint without doing anything. And my impression and my belief is that the community as a whole chased the wrong thing instead of actually chasing the innovation and actual usage and development of the projects. So real life usage versus shiny again things is not let's say followed or not so interesting to the normies. If you are a person that knows his way around, and if you know what to look for, then this is not something that is concerning for you. But the space is full with people that are not, let's say, so into doing their own diligence. And we all saw, and I'm not going to mention anything because it's not the space for this, but we saw bridges failing. We saw layers 2 or halting, or layer 1's halting. We saw governance being manipulated. We saw everything. So instead of delivering fast and cheap, better take some time, analyze, build, and then come and say, we are doing this. So the mistake is that fast and cheap is not always good. And we've had this for quite some years.
Such a great perspective. I have to say that to sum it up, not fast and cheap doesn't always mean good, right? It's just you get what you pay for. So, obviously within, not just in our industry, but every industry, I think there's a value attached to any monetary ecosystem. So yeah, it's a really good point. Also, I wanted to turn over to Scott and Midnight. Go ahead, same question.
Yeah, sure, thanks. The biggest was maybe, let's go with the piece then. So, like last cycle, we saw a lot of like crazy yield opportunities and also crazy valuations and how everything came in, both from a retail and institutional like level. And for me, that just signals that we as an industry were unable to price risk effectively. Like we were getting crazy yields for a day or something like that, but the chance of it imploding were crazy high. And we didn't really scrutinize where that yield came from, what was going on that side of things. So I think that's what we did not great at. They created a lot of speculative opportunities, coming back to all the casino comments, but it didn't really do us any favors in the long run, where I think net probably more people lost than won on that side of things. And you can see now that people are looking behind the yield, like where does that come from? And then also more on like the private company side, like where does the value in this new company or new startup like come from? And we're getting better at that. Now, what that'll actually probably mean is that valuations come down. I don't think that's a particularly bad thing if it reflects the true like risk adjusted return that you can expect. And that's like the main thing that I can see on that side. It's quite a tough pill to swallow because it probably means that we're not all as well off as we think we are. And it also means that we're not as valuable as we think we are. But we can grow into these valuations over time. I will just see more opportunity for RWAs to come in, backed by real yield and real products.
Yeah, it's really great perspective as well. Insight. I mean, DYOR, do your own research. We say that a lot, but a lot of times most people don't do DYOR. So, I think it's a great perspective. Also, I think it's not only do your own research, but also think about the risk involved in everything you do. So not just within crypto. I think it's within any financial investment. So you have to look at both ways. But yeah, that's a really good point. And I think we all have learned from these so-called mistakes in crypto. And I think it's only something that as the industry matures, it only will get better. And maybe the newbies won't do their own research, but eventually they will. But yeah, it's really great stuff. I'm going to go ahead and wrap up. We have some individual questions, and then we're going to go ahead and wrap up the space. But that's all the main questions I have because we're running out of time. So what I'm going to do now is we're going to do individual questions first per project. And then also, I would like you to answer the question and then also tell people where to go get more information about your project. Like, should they join your Telegram or your Discord? If you just want to point them to a website, is fine too. Either one. But yeah, we'll go ahead and start over with Brian. My question to you with stable is, stable coins were supposed to be simple, but they become the backbone of crypto economy. And what did the industry underestimate about building the real digital money, which is stable coins today, there's so many stable coins, I can't even think about them all, but it's just trendy, right? Go ahead, Brian.
Sure. Again, thanks for having me. I would say, you're correct in terms of stable coins are supposed to be simple and easy, and now they're at the front and center of everything. But I think that's obviously the use case brings them to the front and center, and with that, more attention becomes more opinions and more ideas. But I would say originally at first stable coins seemed simple. You were to peg it to $1, and you're basically done. But as people started using that scale, it became clear that issuing the stable coin was just that small part, the tip of the iceberg. But the harder part around it was like, how does it move? How fast does it settle? How predictable are the costs? And then how does it integrate? And I think that was the part of what was really underestimated was like the integration part and how to make sure money moves across borders. So I think that was one of the big things that were underestimated, but then also the user expectations. I think that people expected things to work lightning fast, like the internet that they're using it on, but they underestimated how slow and how congested general purpose networks were. But then also you have to get to things like, clear rules for regulation purposes, custody management and systems and institutions. So I'd say the complexity of the integrations was by far the most underestimated thing of getting stablecoins into a form of like real digital money. I think the idea was relatively simple: peg it, manage the money externally, and you have this token. But the ability to get the breadth or get the depth of the integrations was wildly underestimated. And then to answer your second question, stable's growing. We're launching Stable Pay in about a month's time, but I think the best place to keep in touch with us is here on X. So it's x.com/stable. Pretty simple, but we put out some good releases and notes, but also you can sign up for the emails. We put out a good publication. And again, thank you to everyone at HTX and John for having us today.
Great. Thanks for your time today as well. And make sure to follow Brian and also Stable. Definitely check it out. It's something that everyone uses nowadays. Stable coins is very easy to understand. Check out their website and all that jazz. So thanks again, Brian. My next question is for Tomer with Kima Research or Kima Network. If stablecoins are money, Kima is the rails. What is the biggest bottleneck today when value moves across change?
Thank you. So the biggest bottleneck to today, there are a few bottlenecks. It's hard to say the biggest, but I'd say that probably the biggest is security. That is definitely being underlooked, surprisingly, by many of the creators in this industry, which basically prevents the growth of the ecosystem. Because the big money guys, even though we think that we're great and cool and we have like $3.3 trillion now in the ecosystem, by the way, which out of them you wouldn't believe, but less than 300 billion is actual dollars. You can see it by the stablecoins in the industry. It's like tiny. It's like smaller than Nvidia and many other companies in the S&P 500. And what prevents the industry from growing, exploding, and attracting more liquidity from the real world, from the serious money that is out there in the world, is security. Probably one of the biggest bottlenecks that prevent value to move across chains and within from the centralized world where the big money is to the decentralized ecosystem that we are a part of. That happens due to smart contracts and oracles, who still we all rely on still to bridge assets. This is an old technology that is still being used, and hackers really like to hack into bridges and oracles because they need to hack into one software which was written by men, and then they can just trick it to give it all of the money that it manages, because a bridge manages, as you know, money on various sides of the bridge in order to move the assets. And that's why bridges are getting hacked all the time, and tokens are getting stolen, dumped on the market by the hackers. And again, we are facing another scandal that prevents growth in our ecosystem and makes things harder. Kima's solution basically relies on no smart contracts and no oracles. So it's the most secure way known to men today to transfer assets. And I think that we definitely help this bottleneck. The centralized world, a centralized bank, for example, the European Central Bank, we were speaking to part of their partnership program and some others. Again, I don't want to sound like commercial for Kima, so research about Kima Network and the technology if you'd like. But basically, using our infrastructure, everything can communicate with everything freely, and knowing that the chances, there are many mechanisms on the way that prevent or eliminate the chance of a hack to happen. It makes it almost 1 to infinity in order to try and trick the whole network. And basically you need to hack to all of the blockchains and the centralized players in order to trick us. So this is one of the biggest bottlenecks, and we're completely solving it simply with one SDK, and to the centralized world with a simple one API. Yeah, so basically that's the biggest bottleneck that I believe we have today.
Bullish. Where should they get more information about Kima Network? Just follow you guys on X or go to the Telegram?
Yeah, sorry. First of all, you can also ask ChatGPT. It's probably the easiest, or any other AI Grok or whatever you're using. Just ask what is a Kima Network. That's a KIMA. If you'd like to learn more, you can of course go to kima.network. But if you really want to learn, probably ChatGPT or Grok or one of our other BFFs AIs is the best way. You can follow us on X to get news about what we do and how we operate and what's new is happening in the ecosystem. And yeah, that's it. Thank you for asking and for reminding me. Thanks, guys.
No problem. Thanks for your great insights and throwing the chair at me. I blocked it, by the way, so I'm okay. Don't worry. It's no hospital. All right. We're going to go to Scott with Midnight now. Here's my question to you. As crypto becomes more connected and compliant, is privacy becoming more important, or is it going to be more threatened? Thanks.
Yeah, for sure. The answer to that is that the choice to be private is going to become more important. There's lots of information that we're happy sharing publicly, and there's some information that we want to remain fully private, and there's some that we want to remain private to a select group of individuals. And I think that gradient is going to become more and more important on chain. So as examples, people running payroll on chain, you probably want each individual transaction to be private so that the team who work with you can't see how much you earn. But for reporting purposes, you're probably really happy with the CFO knowing that it's your wallet that's receiving the money and how much has gone in between them. So I think just using simple examples like that we think are great fits for on-chain, we can see how that differential level of privacy is just really clear and really simple. That's how I see the next sort of 12 to 18 months really panning out. The fully private stuff that we see, and obviously Monero is probably the most high profile of it. I think if you want to play with the enterprises and you want a big institutional money on, it's a non-starter, right? We need to have this level of differential privacy so that we can work with regulators in a manner which both protects the users and enables sensible use cases on chain.
Yeah, that's really great. I have to say the privacy meta is really still here, and so I'm glad you guys are, thinking about this idea. And I think it's something that we all can appreciate, when we send a transaction, we're not going to know everyone how much money we have. But yeah, I thanks so much for your time today, Scott, and Tomer and Brian. Scott, where can they learn more about Midnight?
Guys, follow us on X, follow us in Discord. They're the two places that all the good things happen.
Perfect. Thanks so much. All right. We got Kaspa up next. Mike, Kaspa, for you, I have a question. In a world full of layers, twos, and modular change, what does proof of work still matter for the crypto ecosystem? Thanks.
Thank you for this. I think I can speak for 1 hour, but I'm going to keep it short. Or at least short. Having multiple layer twos, multiple layer ones, you have segregation, you have trust assumption, and you have so many point of potential failures, right? So as we all know, a modular chain separates the consensus, the DA, the data availability, execution, so on and so forth. And this trade-off is basically adding complexity and trust assumption. I'm just a side note, I'm a huge fan of proof of work. So of course I'm biased, but I truly believe on what I'm saying. So of course the proof of work consensus obviously matters, and not only matters, is still the place to go, because it is the only consensus that anchors the digital system to an objective external cost, right? What I'm trying to say is that this does not rely on governance committees. You don't need any social coordination to vote or do something. Basically, it's poorly decentralized. And we live in a world that is dominated by modular stacks and layered execution. But at the end of the day, someone still has to be the final arbiter of the truth, right? And proof of work fulfills this role without permission and in a pure, secure, and scalable and decentralized way. So, of course, we all know that, or let's say not know, we all believe or have this initial thought that the proof of work are slow, limited, and they only provide the minimal settlement of transactions and everything that is happening on chain. But Kaspa challenges this directly. Kaspa, as I told you at the beginning, uses a block DAG, which is parallel block execution production and mining. Kaspa delivered fast confirmation in high throughput, and obviously focusing on Nakamoto style security. So this doesn't make proof of work just relevant. It is a highly competitive consensus in environments where speed and responsiveness actually matters. I'm not sure how many people know, but Kaspa had the fork last year. We are at 10 blocks per second, which is 100 millisecond block, and purely done by proof of work via miners across the world. This is no centralized entity. There is no central X account to follow. There is no official, let's say, committee or a group of people that are doing and steering what Kaspa needs to do. I don't know how to emphasize this enough, but you should, for those listening and never heard of Kaspa, I highly encourage you to look into it and see what Kaspa is. But coming back to the question, what often missed is that the proof of work, it's misunderstood, is that the proof of work cannot scale. But Kaspa is doing this, and is doing it natively. And with sufficient throughput and strong ordering guarantees, you can obviously introduce native programmability without doing the segregation of the modular things, without fragmenting security, bridges, and side systems, and so on and so forth. And because, as I was mentioning at the beginning of my response, this is critical because each and every additional layer increases trust, assumptions, and weakness the overall stack of the layer. However, Kaspa approach shows that the proof of work, you don't need to choose between security and usability, or security and speed, or usability and speed, or any combination of this. Kaspa can provide all of them. And the protocol is designed in such way that removes any artificial constraints that are, let's say, believed to be on the proof of work. So at the end of the day, the layer 2s are not inherently bad. I'm not saying layer 2s are bad, you should throw them away. Depending on the niche and the need, you can have one or tens of them, depending on what you want to achieve. But they are becoming problematic when they are used to compensate the base layer limitation instead of extending the capability of the base layer, right? And for example, this is a bit and I'm going to finish in a bit. This is for me it's a bit contradictory because I'm also a business developer for Kasplex, which is the very first layer 2 EVM on Kaspa, and you would say, so you are saying Kaspa is best, but you are still discussing about layer 2. It's not like this, because once the proof of work based layer like Kaspa can scale natively, the layer 2 stop being the patching limitations. But basically what they are doing, they are extending the capability of the layer 1. And Kaspa also has the vprogs, the virtual programming that are coming up, which is going to allow the usage of Kaspa. So it's going to provide the ZK proofs, and they can only be verified on Kaspa without affecting the cost gas, the let's say competition to be in a block. And again, Kaspa has 10 blocks per second and fully proof of work, and it's going to come up to 100 blocks per second. I'm not sure if this is well understood by the listeners, but this is a major breakthrough technology. And to finalize and close my talk, you can follow Kaspa on Twitter. Again, there is no official account about Kaspa, but there are so many good community members and promoting, sharing, and showcasing what Kaspa is. You have so many resources available out there, and you can just search for Kaspa on Twitter, and you will see high accounts trying to explain what Kaspa is doing and is trying to achieve. And if you want a web page, you can go to kaspa.org. And if you want, you have all the links there for Telegram, for Discord, and everything like that. Thank you so much, HTX, for having me. Thank you so much for our speakers, and it has been a real pleasure being with you guys. Thank you.
So much. Thanks for the great information in Alpha. I have my last question with Chloe with HTX Research. Do you see capital shifting from the meme style assets towards real infrastructure in 2026? Thanks.
Yes, I definitely believe that stablecoin and a lot of other kind of infrastructure will do a lot of interesting things, including AI and robotic, including stable chain plasma. I know a lot of robotics project will launch this token this year. So so besides this, I really bullish on both the app, including prediction market and also trading terminal. Yeah, so that is all I want to say. Yeah.
Cool. Thanks so much. That about wraps up this space for today, guys. Again, I want to shout out to all the speakers from today's space. They took their time. They gave us alpha. We got to give them some love. So again, make sure to follow Brian with Stable, Tomer with Kima Network, Scott with Midnight Foundation, and Kaspador from Kaspa, and Chloe with HTX Research. Thank you guys for your great insights. It was fun. I had an amazing time. I hope you did too. And we will see you next time on HTX Space. I'm going to wind down with a little bit of trance, chill music. So we will see you next time. Thank you guys. Bye-bye.